Howdy. Welcome back to Dion Talk. This is a heated topic. This is one where, for almost 2 years, since 2013, really, so almost 10 years, there have been people screaming about a housing crash. And I have been saying there isn't one coming. And if there is one coming, it almost doesn't matter because I'm a buy and hold investor. So a lot of my information is for buy and hold investors, but I hope I can help flippers, wholesalers, people who do the Burr method, people who have different strategies, even people who invest in stocks or growing a business. My intent is to help people reach financial freedom by getting the concept of money down. But my problem has been the people who are looking for an excuse to take no action love crash videos, love crash articles. They get more views, they get shared more. When we see a crash video that gets hundreds of thousands of videos, and I've made two videos, one in 2020 and one in 2021. I might have got that wrong. No, they were both in 2021 on why there's no crash coming. Because the investor that waits, that stops and says, I'm going to sit on the sidelines and then wait for the crash. And when the crash happens, then I'm going to jump back in and find the great deal. So even if that was the case, let's say as the housing crash that we're in right now is happening because interest rates, that was the biggest, quickest change in interest rates that I've seen that caused what I'm calling the housing crash. If you've been on the sidelines for the last 6 months, just sitting there, not taking any action, not doing any work, and you tried to jump in today, pardon my language, you'd have no freaking clue what a good deal was. It takes for an investor who knows his area or their area, knows their rents, knows all of these factors, weeks to figure out what a good deal is until you're dialed in. If you're a new investor and you don't know how to calculate area average rents accurately today, not what they were 2 weeks ago, you don't know how to find your yield based on what those deals have been with current interest rates, which pretty much change weekly, how do you expect to just jump right back in and take action? So I see a lot of people in the comments recently where they say, we're starting the housing crash, so I'm going to sit back and do nothing for 6 months, and then in 6 months, I'm going to jump in. 6 months from now might be the perfect timing. But that means 3, maybe 4 months from now, you need to start doing the work every day to dial in and figure out what is a great deal. I want to cover a couple of the reasons why I think we're in a housing crash. And it's not, my crystal ball is way over there. It's not a prediction. In the future, I think this is going to happen. These are things that are happening right now. For the last 2 years, majority since 2020, when the pandemic hit and everybody swore there was a housing crash coming, Ken McElroy predicted a 40% housing crash. He has since gotten off of that, which is great because I watch a lot of his content. If you get a chance, Ken McElroy, it's a great channel. He's on there with his wife, and the great thing is, he is, decades of experience and a huge investor who does things that I can't relate to. But his spouse is new to investing, has 3 rentals, and is like the dynamic between them. The information is perfect for a newer investor, or in my case, a smaller investor. My goal, right now I have 16 rental units. I reached financial freedom in 2018, and a lot of investors talk about getting to 50 or 100 rental units, and I'm not even sure I want 16. I might sell some, pay off some debt, and increase my cash flow and have less headaches to deal with, because my goal was financial freedom, not a massive portfolio. And when your cash flow, like mine right now, is about 5 times what I spend in a year, I don't know that I need more. I'm going to buy more, especially in this next year. I am super excited for the deals that are going to start popping up. I made a deal today, this morning. I literally texted Matt, the lumberjack landlord, and Michael Zuber, and I asked, does the excitement ever get less when you find a great deal? Because I found a great deal. I have my offer submitted. Because your heart rate goes up, you get nervous. We go through all the same things. 10 years, a little over 10 years of investing versus that first year, same thing. Because it's a great deal, and I don't want to miss it. So I have to run my numbers. I have to make my offer competitively. I have to make sure it's a good offer and not chase the numbers, especially during a housing crash, when progressively each deal that we do going forward is probably going to be better and better than the last one. The difference between this crash and the 2008 crash, and the first thing to talk about is sometimes people will reference, we're going to be hitting a recession. So during a recession, we might see housing prices drop, which is possible. And this is a chart. The yellow is what happened to home prices during 4 of the last 6 recessions, and the orange is the drop in 2 of the last 6 recessions. So a recession doesn't always guarantee home prices are going to go down. The reason we're going to be able to get better prices going forward isn't the recession. It's fear of missing out changing hands. For the last 2 years, while I was screaming at the top of my lungs pretty much that there's not a crash coming, that you need to keep doing the work and to keep taking action, because imagine if 2020 you watched a YouTube channel or read an article that said there's a crash coming, don't do anything, sit back and wait for the crash. We've had over 20% appreciation in 2020 and 2021 in most markets. I think 19 was kind of the average for most places. In my area, around my area, it was 24%. 2 years of that, with a couple $1 million portfolio, you're talking about losing $500,000 in appreciation, which doesn't really matter because that can go away if home prices drop. But we've also seen massive increase in rents. In these 2 years, rents have come close to going up 50%. So if you were collecting $1,000 2 years ago, that's at least $1,500 now. Most of my places that were rented for $11 or $11.50 are now going for $18 or $2,000. That's a significant increase to get in those last 2 years. That's a lot of cash flow to have missed out if I was waiting for the crash or correction. So for those 2 years, I've been saying hunt for the right deal. The one that gets your yield, the one that puts your money to work so you're not losing value to inflation. My advice for the next 2 years isn't much different. You're going to hunt for great deals, but there are some things we're going to do that are different. For the last 2 years, buyers had fear of missing out. We were in a strong seller's market. We had a ton of demand, limited supply because these are homes built by the decade. So each one of these blue charts is each of the last decades. You see the red one? That's the last 10 years. That's how under building we've been. So when people talk about a housing shortage, part of that has been because we're just not building. When the 2008 housing crash happened, builders took it really hard. So where's the motivation to continue that? So we've had really limited building. So we still don't have much supply. It would take tripling our current supply on the MLS, which is going up, to even be in a balanced market. That's how far we were into a seller's market where sellers had all the power. In 2018, you could buy a property and it was pretty much just assumed that the seller would pay closing costs. Since 2020, people had to go, speed is your best friend. You wanted to get an offer in before the seller realized how many offers they were going to get and how much over asking they were going to go. Because a lot of sellers purchased it 20 years ago, can't believe how much prices have increased, and they can't believe that the number the agent is telling them that they're probably going to get. So when they get the actual offer at asking or above in the last 2 years, they jumped on it, and then you get the sunk cost theory where they think they've got time into having accepted your offer. So they might even get offers after that were better that they don't take because they've already accepted yours. So speed mattered. And I mean, you find it on the MLS, you have hours. It's like within minutes to take action. You reach out and get your letter of pre-qualification from your lender, which if you were qualified to borrow $500,000 and the deal you found was worth $400,000, you didn't send off a letter saying you could borrow $500,000 because that lets the seller know you actually have more wiggle room in how much you can borrow. You reach out to your lender and they send you a letter of pre-qualification for $400,000, the amount of your offer. And so my lenders know they've got maybe 10, 15 minutes to respond when I email them for that letter of pre-qualification. I might give them an hour or two if it's on the weekend. And then my agent knows that when I say, this is the offer I want to submit, here's my letter, my pre-qualification from my lender. I need you to make this offer, get it DocuSigned to me in minutes because it goes email, text, phone call, all in about 15 minutes. Because if I don't have that email response, it's going to text and then email or phone call because speed mattered. And most offers for quite a while, and I say most because it's right around 50%, and in most years it was 20 to 30% of offers that would go over asking. Redfin recently had an article where they said 53% of offers were made over asking price, which meant 47% were at or below asking price. So speed, over asking, and then people were waiving contingencies, something that I haven't done and I don't recommend doing. If you were making an all cash offer and you knew your numbers, you can waive an appraisal. So I understood that. But if you had to have money from the bank and you waived the appraisal contingency and you didn't have the money to cover the gap, you could lose your earnest money. Deals aren't that good to risk your earnest money. And then waiving your inspection, to me, that was always a mistake, not because I care about the inspection being done, because you can do that yourself to give yourself that to-do list, but because you need the inspection period. the number of days, somewhere usually between 5 and 10, where you have the actual time to go and look at the property and make up your mind. If you even actually want it, that's when you find out, is the street super noisy? Are the neighbors really messy? Is there some other reason that's not easily discernible from the MLS as to whether you would want that property or not? There was the case where the people offered to name their kid after the seller. They didn't even win the bid, offering to have named their kid after the seller. That's how far we were into a seller's market. So buyers had fear of missing out. I'm a buy and hold investor. I've actually never sold a property, so I can't generally help with that kind of information. I have people I would refer you to if you were selling properties to ask them questions. Here's the shift. The buyers had fear of missing out because prices were going up. So a home buyer buys based on payment. Interest rates were really low. So the fear was interest rates might start to go up, reducing your buying power, or prices might go up so high that you can't afford the payment. So home buyers are there's four people who pay for properties: home buyers, investors, flippers, wholesalers. That's the order of who will pay the most, because home buyers will buy based on payment, investors will buy based on yield. So how much can I make when I buy this property? And then flippers need the margin to be able to exit the deal with profit. And then wholesalers need to be able to get that wedge between seller and buyer so they can get their money. So home buyers were afraid prices going up, interest rates going up might make them not able to make the payment for the house they want. Investors were afraid because I couldn't find the yield. As prices kept going up, it got harder and harder to find the yield. Rates came down, which made us able to pay more because the same amount of money was going out. More money was going to the seller than was going to the lender. Interest rates went up. So now the fear of missing out shifted from the buyers to the sellers, because there are some people who need to sell their house. In every market, there are people who change jobs, move locations, decide they don't want to be an owner, have tenants, death in the family, divorce, all of the reasons why they need to sell, whatever the reasons are. There's a million of them, and you're probably never going to know the real reason why the person that sold the property that you bought even actually sold it. Agents will come up with a pretty good story, but you might never know the real reason. So that's a small element of people who have to sell. There's a large element of people who start thinking, these numbers are huge. I've got a ton of equity that I can 1031 into something else, or I can take out and invest in stocks if they want to get out of real estate. Whatever the reason is, there's a large group of people that were thinking prices are getting so stupid, it makes sense. Michael Zuber did this in 2006 to 2008. He saw affordability dropping so low that it made sense to get out of single family, take all that money, and then buy multifamily. So there are reasons why people make a pivot. If you are the seller and the price goes up so stupid that you're thinking, I don't want to sell my property. I love it, but that money is a lot of money. So now I'm going to sell. But you waited. You're waiting for prices to increase to the stupid number that made more sense to you. And then interest rates have doubled. So not only were people buying properties at low interest rates able to pay more, but people with properties were refinancing to lower interest rates. I purchased properties before 2018 that had interest rates between 5.5 and 6%. In 2020, I refinanced a couple of them to 1 to 3.1, 2 to 3.0. So I did refinances to increase cash flow, which is what I invest for. Now the seller is thinking, prices have finally gone up to the point where I want to sell, and interest rates change. Buyers vanish. Some are priced out. They were qualified to borrow $500,000 2 months ago. Now they're qualified for $380,000 because the interest rate changed the amount of the payment, offsetting their debt to income ratio. So they can't buy the house at the price that the seller decided they wanted to sell it for. The yield disappeared for most buyers because rents have gone up astronomically, but they're not there yet in most markets. So the yield didn't exist. So investors pull out, home buyers pull out, flippers see interest rates go up with talks of interest rates going up farther. So even if they use hard money to acquire, their exit strategy now has to factor in higher interest rates. The Burr method has to factor in higher interest rate for that. All kinds of buyers backed off. I think it was Zillow or Redfin that talked about 72 or 73% of buyers in their poll saying, yep, I'm not going to buy now, which reduced demand. The only reason we haven't seen a massive decrease to prices, which we are seeing decreases from the wish prices, those prices where it started to make sense for somebody to just say, it's so bad now, it's so crazy now, I'm going to sell, because I thought if I have a single family house that when I decided to pay it off, I owed $121,000. Right now, it would get 450 or so, and I think I would walk away with right around 400 to deploy after agent fees and some other expenses for selling. That's almost 3 or 4 times the amount of money. Even I was thinking if I sold that, I could pay off 2 mortgages on a duplexes, or I could buy another small multifamily, and I could increase my cash flow as prices got stupid. But if you waited too long and interest rates changed, all those buyers back off. Here's the reason why we haven't seen like a massive correction. And remember, the biggest housing correction that has ever happened to the market as a whole wasn't in 2009, when we had in a year an 8.9% drop. So people who invest in crypto or stocks, and in March of 2020, we had a 30% drop in most of metrics for the stock market. I know my retirement account took that hit. Crypto, Bitcoin has dropped 40%, 9 times in the last decade. Very volatile, and they bounce around. Real estate doesn't do that. An 8.9% drop in the real estate market across the whole market is the biggest one we've seen in 50 years. Now, there were some markets where we dropped significantly, but as a whole, they didn't. So when we talk about a housing crash, the whole market dropping 8.9% would be the largest drop we have seen. So if it drops 9%, that's a new record in 50 years. What I'm talking about is home prices coming down from the wish list. So if they drop down to 2020, 2021, 2019 prices, is it really a crash, or did they go back to where they should have been because of the low interest rates driving prices up so high with limited building? For 2 years, not 2 years, for the last few months, anytime I talked about a crash, and my friends talked about a crash, my other content creator friends, we were trying to clarify that there's a crash in transactions, that so many buyers have pulled back, and people are locked in. The move-up buyer, the person that used to have a house and would say, okay, so our family's bigger, we've got more money now, we're going to sell and get a bigger house, can't, because they own a house that they purchased at a lower price with a 3% interest rate or 2.5% interest rate. Now interest rates have doubled. So if they go to buy a more expensive house at a higher rate, they're going to, even just getting a lateral house, like the same house with a new rate, could add significantly to their payments. It's called the interest rate lock. There are people locked into those, which were 2 transactions from the housing market. They're not going to sell the house they're in. They're not going to buy the one they would move up to. They're going to maybe take out equity and invest it into their property, upgrading it. But we're removing transactions. So we're seeing a crash in transactions. And me and my friends have been trying to say, we're not going to see a crash in prices. We're going to see a crash in transactions. Well, interest rates went up so fast, we're seeing the crash in transactions, which is causing a couple of things to happen. Lenders and agents are going to start starving, right? 70-something% of people pulling back from buying, the move-up buyer canceling 2 transactions. You see lenders start to be creative with new loan options where you can get part of your down payment compensated. Adjustable rate mortgages start to talk about in a new light, where they were one of the largest factors in the 2008 housing crash. We were over 50% with adjustable rate mortgages in 2006 and 7. Right now, we were at 3%. Now we're up to 11%. So there's a big jump going on there, but we're not at 50%. But for a lot of people, an adjustable rate mortgage doesn't make sense. People with a huge portfolio where it's just on one or 2 properties where they have an exit strategy in the next 3 to 5 years, where the adjustable rate isn't going to sink them, sure, totally get it. It makes sense. But for the average person who hopes for prices to go up in the future and hopes for rates to not be 2 or 3 times what they are now in the future, and hopes that they still have their job in 3 to 5 years, is caught living on hopium. And you don't want to do that. What we're going to find now is those sellers who thought prices have gone up so much that they're silly. I need to sell. Here's the one metric that will make people drop prices, and we're seeing it. I saw it in the deal I made this morning. The offer I made on the deal this morning. Days on market. How many days does a property sit on the MLS is the only metric that will make somebody lower their price. You'll see people list prices too high, too low. The agent has an idea of what will drive the biggest frenzy towards the property. Everybody has a different opinion on how that works. But when they put a property on the MLS at the number that made sense to them, for 2 years, speed was our friend. You wanted to get that offer in fast. Now, I'm not even really looking at properties unless they have at least 10 days on market. Remember, it was 2 hours before properties would be under contract. So in my area now, the small multifamilies that I'm looking at, once they hit 10 days on market, I start looking and thinking, what percentage less what I need to make where I would get the yield I want, where I think the seller could still take it, where they might agree to it, and then I make the offer. That's where our price correction is going to come in. We're going to take the wish prices that sellers are thinking they can get, and we're going to make the offer at the price that makes sense to us based on the other two factors, rents and rates, because rates, rents, and price help you determine your yield. There's a few more factors there, but those are the main three key things that you can watch to understand how it's going, what your number is going to be. So there are some things that you need to do going forward to benefit from this current housing crash, which we can clarify and say it's transactions, but you're going to find the housing crash in price, because we don't need the market to crash that 9% to set a new record. We need where you invest to have a motivated seller, because the ones I've found so far, I don't know about the one today, but the ones from before weren't motivated. They listed at their silly price, didn't get it, so they left it on there. Some pulled it off and said, okay, I'm just not going to sell. We need the person who has to sell. You need to find that person who's got the life event that means I have to sell my property. Here's what I hope to get. And then it sits on the market. And in your area, it might be 20 days. It might be 30 days. It might be 4 days where you think, okay, my under asking price offer with contingencies, because here's some statistics that we've seen. Offers over asking have come down. Days on market have gone up. Mortgage applications have gone down, but there's a cheat there. 2 years ago, a lot of people were refinancing. That's a mortgage app too. Very few people are refinancing now because it doesn't make sense to double or triple your interest rate. Inspections have gone up. That doesn't mean more deals are happening. That means less inspections are being waived. So we're back into, with the sellers having a fear of missing out, not only might you might have better negotiation with the price, but you might have term negotiation. Seller financing might look more attractive, but it can also be inspections don't have to be waived. Appraisal contingencies don't have to be waived. You have more negotiating power once you're under contract. All of the things that we had to waive before, we're not having to do now. So where speed was your friend, here's the winner now. The thing that will make you win today: patience. Don't be in a hurry. I caught myself at that this morning when I got all excited because I found the deal. I was like, this is the deal. This is the numbers. This is the area. This is the rents. This is everything I was looking for. Checked off all but one of my boxes. And I thought, I want to make this offer. Get that adrenaline rush. You get nervous. And I'm thinking, it's been on the market for over 10 days. Why am I in a hurry? Why did I reach out to my lender and then and mentally give him kudos for having that letter back within like 10 minutes? So if you want to use my lender, reach out to me. I'll connect you here in Washington. He's amazing. Why did I, with my agent, poor guy, email, text, call, like I was still doing it from the last 2 years? Because speed mattered, but it doesn't. Patience is what's going to win now. I hope you enjoyed this clip from one of my long live streams. I do my live streams every Tuesday afternoon at 4 p.m. Pacific, and they last as long as the questions do. You can find the entire video here. Until my next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.